Hey traders, and welcome to another episode. Fair value gaps are not what you think they are. Most traders are using them the wrong way, and that's exactly why they keep losing money. In this video, we're exclusively covering fair value gaps from A to Z, one of the most powerful, misunderstood, and misused concepts in trading that every serious trader needs to master before even thinking about placing a trade. We'll dive into the different models and types of FVGs you'll encounter on the charts, and more importantly, I'll show you how to identify and use high-quality fair value gaps with a higher win rate using mechanical, repeatable rules. But that's not all. I'm also revealing my 2 top fair value gap trading setups, breaking them down step by step so you can apply them instantly to any chart. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. First, what is a fair value gap? A fair value gap forms on the chart when there's inefficient price delivery. This usually happens when price moves rapidly in one direction without any significant pullbacks. This kind of move leaves behind liquidity voids and unbalanced price action, often appearing as a gap between candlesticks. These gaps act like magnets because price tends to revisit and fill or rebalance them over time. As a result, fair value gaps present high probability trade setups, since price often bounces after retesting them. Before going any further, let's have a quick recap about inefficient price delivery. There are 3 types of price inefficiency. The most common one is the fair value gap. It usually forms within a 3-candle sequence and is easy to spot on the chart as a large impulsive candle. The distinguishing feature is that the upper and lower wicks of the neighboring candles do not fully overlap the body of the middle candle. This creates a visible price void, known as the fair value gap zone, which is drawn from the body of the middle candle. Price tends to come back to rebalance this zone, making it a strong area of interest. The second is the volume imbalance. It refers to a gap between the closing price of one candle and the opening price of the next. While there is still some trading activity, there's an imbalance in the volume transacted, hence the name. Price often reacts to these imbalances as the market seeks equilibrium. And the third type of price inefficiency is the opening gap. This is the easiest inefficiency to identify. It's a clear price void that appears between the previous day's close and the current day's open, with no candles formed in between. These gaps usually fill quickly as the market corrects the overnight price dislocation, offering great short-term trade opportunities. The key difference between a volume imbalance and an opening gap is that volume imbalances have trading history and candle overlap, especially wicks, while opening gaps show a complete void, meaning no trading occurred in that price range. Now let's break down the core psychology behind fair value gaps and understand why price respects them from a market structure perspective. To fully grasp this, let's zoom in to a lower time frame and analyze the 3-candle sequence that forms an FVG. What you'll notice is that price typically creates a strong, bullish structure with momentum, driven by high buying pressure and a clear lack of sellers. This sharp move often leaves behind inefficient price action, a gap, or void, known as the fair value gap. Here's where the psychology kicks in. Many traders miss out on the initial impulsive move and hope to catch a pullback. So what do? They start placing buy limit orders around key zones like demand areas, order blocks, or the fair value gap itself, waiting for price to return. As these buy limits pile up, a liquidity pool is formed inside the gap. The market, always seeking liquidity to fuel its next move, targets this area. At the same time, since the number of buyers outweighs the sellers, price keeps climbing until it hits a significant supply zone, where enough sell-side liquidity exists to balance the demand. At this point, the market starts to reverse temporarily. Why? Because it now needs to rebalance the inefficiency it left behind. It comes back, taps into the FVG, sweeps those pending buy orders, fills the imbalance, and then resumes the trend with renewed strength. That's why FVGs are so powerful. They're not just technical gaps, they're liquidity magnets formed by real trader behavior. Understanding this gives you an edge. You're not just trading the pattern, you're trading the reason behind the pattern. Fair value gaps generally fall into two main models, classic and inversed. Let's break down the classic model first, which is divided into two key types. Number 1, BSI, buy-side imbalance, sell-side inefficiency. This is a bullish fair value gap that forms when price moves rapidly upward, without providing enough opportunity for sellers to participate. This imbalance creates a gap, a lack of sell-side delivery, which the market later seeks to rebalance by pulling back and offering fair value for sellers to enter. The retracement into the BSI zone often provides a high probability buying opportunity. Number 2, CB, sell-side imbalance, buy-side inefficiency. This is simply the bearish version of BSI. It occurs when price drops sharply without enough buy orders to support the move, creating an imbalance on the sell side. The market then retraces upward to offer buy-side delivery and fill the inefficiency before potentially continuing downward. There are three key levels within a fair value gap that traders should pay attention to: the premium high, the discount low, and the midpoint, also known as the consequent encroachment. Now you might ask, which of these levels is the most important, and how do we use them? The answer is, the most critical level is the consequent encroachment, which is the 50% midpoint of the fair value gap. If price returns to this level and respects it, it's a strong sign that price may continue in its original direction. For example, in the case of a CB, if price re-enters the gap but violates the midpoint without showing rejection, it's often a sign that the market intends to move higher, invalidating the initial bearish imbalance. What is an inversed fair value gap? An inversed fair value gap occurs when price disrespects a regular fair value gap, meaning instead of reacting to it, price breaks right through it. When this happens, the original FVG flips its role and often acts as a new support or resistance zone, depending on the direction of the breakout. This concept follows the same logic as supply and demand zones. When price breaks through a supply zone, it often becomes a demand zone, and vice versa. The same transformation applies to fair value gaps. For example, if price breaks through a bearish CB fair value gap instead of respecting it, that gap turns into an inversed FVG, which is more likely to hold and act as support going forward. To visualize this, imagine we had a bearish CB FVG that was violated by two strong bullish candles. This breakout created an inversed fair value gap. As price retraced back into the zone, it respected the consequent encroachment and then continued to move higher, demonstrating how the FVG flipped and served as support for the next leg up. As I mentioned earlier, not all fair value gaps are created equal. Some are far more likely to result in. Sounds good to you? Check the link in the description to get started. Number 1. Fair value gaps formed within kill zones. Fair value gaps that appear during specific time windows, like the London or New York kill zones, are more likely to hold and work effectively. For example, if a fair value gap forms during the distribution phase of the London or New York session, and within the kill zone time frame, it should be treated as a high-quality FVG. These types of gaps carry more weight and typically offer a higher probability of success compared to those formed outside these key windows. Number 2. Fair value gaps at break of structure or market structure shifts. FVGs that form during a break of structure or those that trigger a market structure shift are statistically more reliable. If you spot a fair value gap created as a result of a break of structure, like the one shown here, it's a sign of strong momentum and institutional activity. These gaps are more likely to act as solid support or resistance. Price often returns to fill them before continuing in the same direction, offering a great trade opportunity. Number 3. The FVG must be unmitigated. To qualify as high quality, a fair value gap must be unmitigated, meaning it hasn't been touched or filled by price yet. Fair value gaps are considered one-time use zones. Once price has reacted to and filled the gap, it's no longer valid or useful for future entries. Also, you can often predict the market's next move based on how price behaves when it first enters the FVG. If price respects the FVG and rejects upward, it likely acts as support, and we can expect a move toward buy-side liquidity. But if price violates the FVG by breaking and closing below it, the zone flips into an inverted FVG, now acting as resistance, and price is more likely to target sell-side liquidity below. Number 4. Location at market extremes. FVGs found at market extremes carry a much higher priority than those in the middle of a range. In a bullish market, you should focus only on FVGs in the discount zone. In a bearish market, look for FVGs in the premium zone to find short setups. These zones align with optimal trade entries, giving you the best possible risk-to-reward setups. Now, let's move on to the trading strategies that I personally use to trade fair value gaps. Strategies that work perfectly when applied correctly. Starting with one of the most effective trading strategies that perfectly aligns with classic fair value gaps in the market. This powerful setup combines the classic FVG model with a liquidity sweep pattern, and it works beautifully in both bullish and bearish market conditions. In a bullish market profile, this setup plays out when price sweeps sell-side liquidity, such as the lows of a key demand zone, a major low, or a cluster of lows, right before tapping into an unmitigated bullish classic FVG. Once the fair value gap is filled, price usually reverses sharply and continues in the upward direction, resuming the trend. Similarly, in a bearish scenario, the setup occurs when price sweeps buy-side liquidity, like the highs of a key supply zone or a group of highs, and then taps into a bearish classic fair value gap. In both cases, the core element is that liquidity is swept immediately before the gap is filled, which creates a strong reaction zone for the price. What makes this setup powerful? The psychology behind this setup is simple but very effective. The magic happens when the market clears out liquidity and mitigates the fair value gap at the same time. When the market sweeps liquidity near a key area, like a low or high, and simultaneously mitigates a fair value gap, it removes two forms of sell-side or buy-side pressure. The liquidity void of the fair value gap. The stop-loss orders of early traders who entered prematurely. This clears the path for the market to move decisively toward the next liquidity pool in the direction of the trend. So, in a bullish market, once price sweeps the lows and fills the FVG, there's no more sell-side liquidity left to grab. That increases the probability of a sharp move toward buy-side liquidity, aligning with the overall bullish narrative. This is exactly what makes this strategy so effective. It's not just technical, it's rooted in market logic. To take advantage of this high-probability trade, place your buy limit at the highest point of the bullish fair value gap. Set your take-profit target at the nearest buy-side liquidity, usually above a recent high or an area of clean highs. Let's break it down with a real example on the 5-minute chart of Pawn Dollar. Price is clearly in an uptrend, marked by multiple bullish breaks of structures. Price suddenly breaks below a recent swing low, but instead of confirming a bearish reversal, it taps into a bullish fair value gap sitting just beneath that low. This move sweeps sell-side liquidity and simultaneously mitigates the gap, and then price immediately bounces back up, continuing the primary uptrend. Look closer, and you'll see that right after this bounce, price begins to build a new liquidity pool above a freshly formed fair value gap. Since all the conditions we've discussed are present, liquidity sweep, unmitigated FVG, and market alignment, this becomes an ideal trade opportunity. Set your buy limit at the top of that new bullish FVG and aim for the next clean high as your target. Now let's move on to the next advanced trading strategy, which is built around inversed fair value gaps. In this setup, we combine the concept of violated FVGs, also known as inversed FVGs, with liquidity sweep patterns to form a high probability and profitable strategy. Let me walk you through how to use this model effectively in your trading. Here on the 30-minute chart of Euro-Dollar, the overall market direction is bearish. You can see that price sweeps the buy-side liquidity just above this structural high, fills an inefficiency, and then sharply reverses back down, signaling a potential move towards sell-side targets. Next, I zoom into the 5-minute time frame to search for a violated bullish fair value gap, what we now call an inversed FVG. As you can see here, after the buy-side sweep, price violates this bullish fair value gap by breaking below it and closing beneath the zone. This break confirms the transition of that FVG from a potential support area into a resistance zone. Additionally, The price has created a market structure shift at this point, offering another layer of confluence for a bearish setup. With all these confirmations in place, we can now anticipate that price will return to the zone of the inversed fair value gap, which now acts as resistance, before continuing lower to target the sell-side liquidity. For executing this trade, we have two different entry options based on how aggressive or conservative you want to be. Option 1. Place a sell limit order at the lowest point of the inversed fair value gap. Option 2. Use a more refined entry and place your order at the consequent encroachment, which is the midpoint of the FVG. This option usually gives you a better risk-to-reward ratio. For your take-profit levels, there are also two valid approaches. Target the nearest sell-side liquidity on the same time frame, or aim for a higher time frame draw on liquidity if you're going for larger potential gains. In this case, I'm going with option 2, placing my sell limit order at the midpoint of the inversed fair value gap. My stop loss is placed just above the swing high that formed during the liquidity sweep. For take profit, I'm targeting the closest sell-side liquidity, which is located below the swing low. Now let's hit play and see how this setup performs. As you can see, price pushes back up into the zone, taps the inversed FVG, which now acts as a resistance level, and triggers the sell order. After that, price reverses with strong bearish momentum and moves sharply downward. Finally, it reaches the take profit level, validating the strategy with a clean, high-probability move. This setup shows how powerful inversed FVGs can be when combined with liquidity sweeps and structure shifts. It gives you a precise, rules-based entry model that aligns with the true intent of institutional price delivery. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.